Hi everyone, it's Drew. Today I'm going to give you a walkthrough of our Lifetime Investment Growth Calculator. This is a very interesting tool, and the purpose of it is to show you the power of compounding through your entire life. You get to pick how often you want to invest, the dollar amount that you'll put in during that investment period, how long it'll compound for, and what the interest rate is. So it will then go out into what I call two different phases. There's the investment phase. So this is during the period of time that you're putting money away for every period that you determined up here. And then the accumulation phase, which results in a certain dollar amount by the time you want to retire. So let's give this a little bit of a workout, and I'll show you how this works. So in this first block, it's periodic frequency, and you can pick day, week, month, year. We're going to stay with weekly. Let's assume we're going to invest on a weekly basis. Then we're going to pick whether the investment is made at the beginning of the period or the end. We're going to assume that we're putting in the money at the beginning of the period. So we'll put start. The green field here has 52 in it. That is automatically calculated by the calculator. That tells you there's 52 compounding periods on a weekly basis in a given year. And then starting funds. It's currently set to 0. Let's leave it at 0. This assumes that you've got no money in your account. You're starting out from scratch. And then periodic contribution. Let's assume that you feel like you can put $20 away every week. Retirement age, right now it's set to 65. Let's leave it at 65. Let's assume that you're going to retire at 65. And I'm going to jump down here. Investment age start. Let's make that 18. Let's say you get a job in high school and you're going to start investing at the age of $18, $20. And then you're going to do that for 30 years. So let's make this 48. So you start at 18, you go to 48. And then the annual rate of return is, I'm going to leave that at 10%. So let's go over to the table and the charts and see what happens. Well, for this type of an investment, 30 years at 10%, $20 a week. When you get to be at the age of 48, so you're going to be 30 years down the road, you'll have $220,000 accumulated in your account. And then you're going to go another, 17 years, letting that money compound out during the accumulation phase. And when you get to retirement at the age of 65, you'll have $1.1 million. And that's pretty good, right? $1.1 million. But let's say we go up here and we change this from 10% to 12%. Well, now we have an account that's worth $348,000 at the end of the investment phase, but we've jumped up considerably in the value at retirement to $2.3 million. So this is a big jump. Just in 2%. We scroll over here to look at the charts. The blue part of this shows the investment phase, the money being increased while you're putting money away. And then it shows the importance of compounding. After you're done putting money into the account, it keeps continuing to increase. So the whole idea here is you just don't touch the money. You let it grow. We have another graph here that explodes out the investment phase, gives you a little more detail during the investment phase, shows you the value as you're putting money away. And then finally, it shows the account equity during the accumulation resulting in retirement down the road. So that's the Lifetime Investment Growth Calculator. All these variables over here are changeable. This will give you quite an idea of the power of compounding of your assets as you're heading into retirement. Thanks for watching.